Hello, welcome. It's Monday. Yay! Another new exciting week. Okay, I'm excited. Hope you're excited. Things are exciting. Things are happening. Yay, I'm very excited for that. We're going to talk about how to get a guide to getting more working capital for your business. Who doesn't want more money? Now, it's not always true. Not always true. All right, you're new here. My name is Taylor Darcy from Think Legal, where I help you create the business of your dreams. So welcome. I'm excited to have you here. If you've stopped in and you're just now joining me, tell your friends, tell your neighbors, tell everyone, please, I'm here. I'm here to help your business succeed. I want to help you. Help me help you. Help me help you. Anyway, exciting things are happening. Business is picking up. I'm helping more people. I love it. It's great. It's my favorite thing to do in the whole wide world. So please, I mean this, subscribe, like, hit that bell icon so you're notified of when I go live, because I would love it. And I mean this nicely. If you'd have time is precious, time is valuable. I totally get it. If you were to show up and comment and chat, that would be awesome. Because I go live every Monday through Friday, except holidays, at 11 a.m. This time, right now. Yay, we're here. That's awesome. Please come. I mean, I'm not going to beg. I'm just saying, who doesn't want help with their business? I'm just throwing it out there. Just hear me. Let's get started. Let's start talking about that guide to getting more working capital for your business. I don't know about you, but starting a business is very exciting. I love helping my businesses get started. It's like my favorite, really, and it truly is my favorite thing to do. But one of the issues that a lot of businesses face is, how do they get money? What's the easiest way to get money? What's the cheapest way to get money? That's the other part. So we're going to break it down for you. Now, there are, by its very nature, there are books, entire books written about this, about your capital structure, how to get capital, who you should get capital from. I have several of these books. I've read them. They're all great. They're all very informative. So we're going to talk about these things in context of what I think works the best for you, that I've seen based upon the many businesses that I've helped get started. Okay. So I don't want you to think that that there's other ways that this is it. This is the only way to do things, because there's so many ways to do it. And here's the other thing. The more creative you are within the bounds of the law, don't go outside the law, but the more creative you are with building your business with capital, right way, talking with people, building your business, the better off you're going to be. And the reason why I say this is because people don't want to wait. And I totally get that. But here's the thing. Patience as an entrepreneur is your friend, is your best friend. You should be as patient as, Mother Teresa. Think of the most patient person in the world and then model your business after them. I know that's hard, especially when you have bills that are coming and going and and it's just a big fat pain in the butt to get stuff done, because you don't have enough money to cover all of the things that you need to cover. I understand the workings of an entrepreneur. I am one myself. I do YouTube, podcasts, my legal practice. All of these things take time, and they do unfortunately take money. But what I'm talking about here is, as you are patient, the getting more money for your business is going to be easier. Because here's what you don't want. You don't want to be a moment away from going out of business asking for money. Investors won't give it to you. Or if you've just started, investors will be like, no, I'm not giving you my money because you haven't shown me that this is a viable product. Nobody wants to buy it yet. I'm not giving you money. It isn't just about being patient, but it's about being strategic. And that's probably the best thing I can tell you about raising capital for your business is that you want to be strategic. You want to think long term what's going to be the best for your business, not what is immediate, what is expedient now. People get themselves in trouble because they take on too much debt, or, and my personal favorite is they try to get investors too quickly before they've shown that they've got a viable product, and then they regret it. Either because it's debt, which is obnoxious. I totally get that because it's hard to pay debt. I totally get that. Or you've got an investor that's breathing down your neck to get something done, to make money because that's what they're in it for. And so neither scenario is great in the beginning because there's so much uncertainty. Okay. Now, that being said, if you ask most businesses what's the number one issue that they face, it's how to get more money. Like that's, I mean, there's not too many problems in business that money won't solve. I'll be honest with you. That's the truth. Money will solve 85, 90, maybe even 95% of your problems. The problem is if you just throw money at a problem without being strategic about that money and about the problem that it's throwing, then you might just be throwing it away instead of it being beneficial to you. So we're going to talk about that. But I want you to just, again, it's about being strategic, patiently strategic. I know, I totally get it. You got this brand new spanking awesome idea and you want the world to know about it and you want to make money on it. I get it. But the more impatient you are, the more likely you're going to go out of business. The more patient you are, the more likely you're going to stay in business. People that stay in business are the ones that are like, okay, I can get through this, whatever it is. I'm going to figure a way out, whether it's increasing your marketing, whether it's increasing, whatever it is. And we'll talk more about those in other episodes. But for this episode, the very first thing that you're going to need, okay? I mean, we're talking like the most crucial to get investors or to get loans and whatnot is a good business plan. Now, I'm a part of a lot of entrepreneur groups, and a lot of entrepreneurs are like, well, I don't want to do a business plan, or, oh, the business plan I have is sitting in dust and it's not doing me any good and I didn't get anything off of it. Except for, here's the thing. Doing a business plan isn't just about getting investors. Doing a business plan is about thinking through strategically the things that it's going to take to help your business grow. So you want to take time on this. You want to give it the love and attention that a business plan deserves. Because the more thought out, and I don't just mean facts, figures, and numbers, but the more you face it and go, this is going to represent my business to people. We used the car analogy last week about when you're selling a business. The same thing goes for when you're trying to get working capital. The more, the sweeter the business plan looks, the better it looks for the potential investor, the more likely you're going to get an investor. Again, you want to polish those rims. You want to polish that paint job. You want it to make it look perfect. When you're looking for money, who's going to take you to the dance, so to speak, you're going to want that person to know that you're dressed and ready to go, that you've got on your tux and you're ready to do your duty. You're going to kick butt, right? So maybe, and I'm not saying, whatever, just look your best, get your haircut done, right? Well, that's what a business plan needs to be. You need to have these elements in a business plan to make sure that it's clear and that the investor wants to invest. Now, not every investor is going to invest, okay? That's just, you're going to get a lot of no's, and you got to have a thick skin about that because it's not just no, it's not you, it's not your dream. Maybe it's just not a good fit for their portfolio. I don't know. I don't know the investor. But that's the point of this, is that the idea being that you've got to, when you're focusing on the business plan is what's in it for them. And the same can be said for what's in it for you, okay? Because you're the primary investor. But lots of people don't think about that. They always think of an investor as somebody outside of the business. That's not true. You are the primary investor. So doing a business plan on what you want out of the business is an important part, because when you find like-minded people that want to be a part of your business as well, then money is going to flow very freely. Just is. So keep that in mind, that when you're developing this business plan, that you are the primary investor. You're the one that has the most say in everything that goes on. Now, my next point is that you want to make sure that you're applying for, when you're ready for investors, whether it be investors or debt, equity, or debt and equity, that type of thing, that you really, really, absolutely, positively need it. One of the problems I see very frequently is that a lot of entrepreneurs want money too soon, and they haven't expended all of their own resources to get it. And that's a problem, because, for instance, when it's a debt holder, it may not be a viable business yet to give them debt. And so there'll be a lot of people that will be like, yeah, I'm good. And you're not going to get those loans that you want, because you haven't invested yourself or your money into that business sufficiently to make people want to give you a loan. So on average, you're looking at 2 to 5 years before you can get a loan. And most of you are sitting there going, what? I need money before that. Okay, that's fine. But you have to understand, we're talking about outside money. So the revenues from business and your own capital can get that business running, keep that business going until you're eligible to get those loans, right? Most companies want to see 2 to 3 years tax returns before they'll loan you some money. They want to see that you're able to stick it out, that you're able to generate a decent sized revenue. Okay. So, and then equity holders, like outside angel investors, that type of thing, they want to know that there's a potential for investment there. Okay. And that means that not only is there a viable business plan, but the financials to back it up. That it's not just pie in the sky, wishing and dreaming, that people, that you're hoping and wishing, right? That's the last thing you want to look like. You want to strut into that room like you know exactly what you need to get what you're going to get. And what type of investment is for that person or investor. What do I mean by that? They may be looking for a specific type of investment to add to their portfolio. No investor I know has one type of investment that they look at. They look at lots of different investments, and if it fits in their portfolio to make them a profit and to average their diversity out, then it's a good fit. Okay. But you need to be that, be the change that you wish to see in the entrepreneur world. That's the key to all of this, is that you need to be, like I said, dressed in a tux or wearing the best dress, whatever it is, right? You want to look outstanding, but not just look outstanding, but be outstanding. That's why I was saying, like, you have a good business plan, but you have financials to back it up. That's a lot stronger than someone that just has a good business plan with no financials to back it up, or vice versa, right? You got good financials, but your business plan stinks. That's a surefire way to get passed over. It's like putting a LS1 engine from a Corvette into a Ford Pinto. Sure, it's got a great engine, but it looks like crap, right? So that's the last thing you want to do. You want to dress it up. You want to fix it up. You want to put the right engine in the right vehicle, and you want to put it to the investor or potential investor looking as its absolute best. Great financials, great business plan, be professional. Don't take yourself too seriously, but seriously enough that they know that they can trust you. This is a relationship, and the best way to build this relationship is by being as trustworthy as possible. If you've had some struggles, be honest with them about it. The relations that you have, they're going to want to know that. Any entrepreneur worth their salt, any entrepreneur or investor knows that a business is not perfect, that there's ups and downs and rounds and every which way. And I mean, we know that. So we can tell you're lying to us if you're telling me that everything is perfect. You'd think we don't know that? I mean, like when I'm looking at a deal and I see it, that it's just presenting its best foot forward without any potential of downside negative, that tells me that the entrepreneur isn't being truthful, and I won't touch it. I wouldn't touch it at all. So you got to keep those types of things in mind. Be truthful. I'm not saying you would lie, but don't withhold detrimental things, but have an answer for them, right? It's like with my kids. I tell them it's going to be a lot worse if you don't tell me the truth, right? Tell me the truth. What happened? That's the best. So just be brutally honest. If something worked or didn't work, or you tried it and it didn't work. Now, if you have a string of failures, well, that isn't going to work. But I'm just saying, like, if you have some failures that are hurting you, address them. Tell the people what you've learned from them. Tell the people that this is what you've done to correct those so that those mistakes won't happen again, or those errors or whatever it may be that caused those things to happen won't happen again. You're going to face other errors. You're going to face other mistakes. That's to be expected. Nobody expects you to be perfect. But if you don't tell us the truth, if you don't tell the person looking at the deal the truth, then more often than not, you're not going to get anywhere with it. I'll be honest with you. So on to the next thing. Return on investment. This is a famous ROI. That's really what it's all about in the business plan, and what you need to think of to getting more capital is that you need to make sure that you're preparing to give that person or that company or whoever it is that's investing the best return on investment possible within the bounds of truth. Again, talked about that, but you want to make sure that you're not inflating your numbers, or not padding your numbers, or not fudging your numbers, or overly optimistic numbers, especially since unless you're truly in a new industry, doesn't really happen. I'm not saying it doesn't happen ever. I'm just saying it's not that common. There's app developers, tech companies, blah, blah, right? There are different versions of things true. But my point is that we know approximately what we should expect to get for a return on our investment when we're looking at deals, okay? And when that's true, then if your numbers are so far outside that, either low or high, then we're going to be a little skeptical. Now, what's normal, right? What's in that average? 1%, 2% more or less, whatever it is. I don't know. That's my answer, is I don't know. But the point is that if you're 5 to 10% higher, we're smelling smoke, right? There's fire somewhere there. Cooking books, I again, lots of possibilities, so I'm not going to go into those. But you get what I'm saying is your books, you want to make sure that they're accurate, they're representative. And I'm not suggesting you would intentionally do it. I'm saying maybe you're trying to put lipstick on a pig. I don't know. You're trying to make you look better than you really are to get that money. And I get it. But at the end of the day, be truthful. Give the investors or the debt instrument, whoever it is that you're trying to get money from, be truthful, because there's nothing worse than getting a loan you can't repay because you got the loan. And you don't have the budget or whatever to actually sustain it. Now, most of them will do again, financials, and make sure that you've got the numbers to support it. So I'm not saying don't, but don't overly inflate your business plan if your numbers don't really work for it. All right, so the next thing we're going to talk about is what's called the weighted average cost of capital. So debt typically costs less because of where it sits in this debt structure relative to the equity. It can be anywhere between 6 and 15%, and depending on your credit and whether it's your business credit or your credit. And then you have your own owner's equity, but then you also have equity that you might have for investors. That totals up based on the percentage that you have of each of the debt and the amount that's borrowed from it, what your weighted average cost of capital is, or WACC. And what that does is that's an indicator of your total fiscal health, monetarily speaking. Like, that's just an indicator. It's not the end-all be-all. It's not everything, but that's one factor that companies or investors will look at. How much are you spending on debt versus how much is equity? Equity typically runs more than debt because of its structure. There's more risk involved. There's more likeliness of loss. So you got to keep that in context, that it's not always about the money that you're getting. It's about where they're at. In a debt situation, debt holders are more likely to be paid out if there's insolvency or bankruptcy. Equity holders are less likely, very unlikely to get paid out. So they need a higher return on their investment. That's why we talked about ROI first. Versus the debt holders need less because they're more likely to get a portion of the assets from them. So this is your guide to getting more working capital. Think about this. Think strategically. Start working on that business plan if you haven't already. If you've started working on that business plan, how have you progressed? Have you moved forward with it? Are you moving forward with it? Are you looking to actually implement it? So many entrepreneurs I know don't actually implement it. They do it as a thought exercise and then never implement it. The problem with that is that shows a lack of strategic thinking for investors. And it goes to your credibility as a person, because finish what you started, but also it's okay to update it. There is nothing that says that just because you start out as a business plan doing one thing, saying one thing, doesn't mean that you can't update it. Do it quarterly. Take a look at that business plan quarterly and say, oh, you know what? We missed our goals for that quarter. Here's what we need to do. Here are the numbers that we need to reach, and here's how we're going to reach them. We're going to cut some expenses here. We're going to increase our investment here, or we're going to try to work on our revenue here. So you're going to play with it, okay? And you're going to get there, and you're going to nail it in. You're going to nail it down and get it good. But it takes looking at it frequently. I mean, even once a month wouldn't be too much. First month, paychecks, or even bi-weekly. If you're sitting down doing paychecks, sit down and look at your business plan. Sit down and look at your financials. The people that are usually the strongest are the people that know where their numbers are and know what they need to do to get to the next number, okay? Because they're active. They're not just passive hoping, right? They're doing the stuff, the techniques that they need to do to build their business. The people that are passive and just hoping for business to come their way and, okay, if it comes, great. If not, we'll scramble, figure it out. Those are the people that are the least likely to be successful. People that address problems early and often are more successful, or more to the point, don't let them become problems to begin with. Those are the best ones, right? I mean, yes, you can't figure out every possible problem. I'm not suggesting that. But I am saying that if you're looking at your business plan, you're looking at your numbers every other week, once a month at the very minimum, quarterly, if you're really crazy business, if it's really crazy business, holy moly, if it is crazy busy, there we go, then I understand. Set up a schedule and stick to it. Because the more you pay attention to those things, yeah, it's not all about the numbers. There's other things to worry about. I'm not saying to worry about them all the time. But the more you pay attention to them, the more they can guide you. And then all of a sudden, you've got a solid plan, right? You're going to get that capital when you need it, when you want it. And maybe not. That's the best part, is if you know your numbers and you know where you're headed and you know where you've come from, maybe you can survive on revenue alone. Maybe you don't need to go into debt. Yay! Maybe you don't need that outside equity. I always recommend people stay away from it until they really need it. And I mean, like, actually positively, not just kind of sort of need it. Again, it's easier to get investors when you don't have a need. And the reason for it is that if somebody gives you terms that you don't like, you can walk away. And that is strength. That is power. That's the type of business that I'm talking about you building, is something that if the outside investor or the debt is, 15, 20, 30%, you're like, no, then you can walk away. And it doesn't hurt you because you've got other avenues. You've got more opportunities. You don't need it. It's just something that is useful for you to have. Maybe you wanted to have a few more in your cash reserves to be able to do something. I don't know. I'm just using this. So you have to put that project off for a little while longer. But you've got capital to keep your business running, moving forward, that type of thing. Then you're good. That's good. Good. Just saying. Because at the end of the day, when you have that freedom, that's true freedom, right? Not having debt payment unless you have to, not having equity holders that are, breathing down your neck for that profit. That's a fantastic position to be in. It is. You're going to be so much happier and so much more savvy because you've been able to make it work without having to get outside investors. And what's even better is eventually, if you're so good, and this is the best part, people will approach you and ask you to invest in your company instead of you approaching them. That's when you know it's right, or that's when you know you've done a good job, I should say. Because it may not be a right investment situation, but it may be that, but it's better to have them coming to you than you going to them. Because again, it's about need, right? The longer you can put it off and not have that need, then the longer and the better that it's going to be when you actually do need it. Because if they're coming to you, not only is that a better position to be in, but also if in the future when you need to go to them, they know that it's a real legitimate thing, not just you're kind of hoping for it, right? So that concludes our guide for today of getting more working capital for your business. I'm going to put a link down in the below for the book that I refer to, that I use as a reference. It's a great book. You can get it on Amazon. I don't remember the price. I want to say it was like $30, $35, somewhere in that range, maybe even $50. And it kind of walks you through these steps and these process and talks a lot about what we've talked about. But I want you to have a guide. I'm going to get there eventually, but I do not have one right now. If you've gotten value out of this video, please don't forget to hit subscribe and like and hit that bell icon so you're notified of when I go live, because I would love for you to come on. Again, I want to make this fun. I want to help you build your business, but part of building your business is showing up, and that's showing up for your business. So look at me as an opportunity as a trusted advisor to help you build that business. In the meantime, always, work on that business. Give it the love that it deserves, and it'll love you back. Take that time. So we go live Monday through Friday at 11 a.m. and except for holidays. Have a good one.